Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at ACHR Aviation.
If you find our talks useful, please consider subscribe, like, and comment underneath. And speaking of useful things, before we jump into today's hook, I want to quickly mention StockOracle.
Right, there's a special 14-day trial link for that right down in the description.
Exactly. Just a quick heads up for you, it is an affiliate link, so the channel might earn a commission if you use it at no extra cost to you.
Yeah, and we always like to remind everyone that StockOracle is an AI-aided stock research platform, right? It's not financial advice, and it's definitely not a trading signal service or real-time market data.
Totally. I mean, AI insights and valuation estimates can be incomplete or just wrong sometimes, so you always have to verify the important facts yourself.
For sure. But it is a great tool for building context, so let's get into ACHR Aviation.
Yeah, let's do it. Imagine watching a stock just absolutely plummet like 56% in a single year.
Oh, that is brutal.
Right. Zero revenue coming in, they're burning through cash at an astonishing rate, and the stock is hovering dangerously close to its 52-week low.
Normally, when you see a wealth building setup like that, you expect everyone, especially the smart money, to be running for the nearest exit.
Exactly. You expect total panic. A textbook falling knife, you know?
Yeah, the fundamental thesis breaks down, the chart bleeds out, and institutional investors just liquidate to stop the pain.
But then you look at ACHR Aviation, and that normal financial gravity just seems to turn off completely.
It really does.
We're looking at an extreme dichotomy today. On one side, you have this pre-revenue startup getting hammered. But on the exact same day, heavy-hitting institutional investors and company insiders are quietly, methodically scooping up shares by the millions.
Which is just the absolute definition of a market disconnect.
Right.
You're looking at an asset that is bleeding on paper, yet the people who arguably have the most intimate insight into its day-to-day operations are aggressively doubling down. They aren't panicking at all.
They are accumulating. So our mission today is to unpack this specific disconnect for you. ACHR Aviation initially set out to completely revolutionize how we move people through the sky, right?
Yeah, they build electric vertical takeoff and landing aircraft. The industry calls them eVTOLs.
Right. So if you've ever pictured those futuristic flying taxis zipping you from a downtown helipad straight to the airport, that's ACHR.
But what we really need to explore today is how a recent massive strategic pivot might be transforming this company.
Yeah, moving them from a highly speculative consumer mobility startup into like a dual-use defense and logistics powerhouse.
And understanding the mechanics of that pivot is genuinely the only way to make sense of what's happening with their stock right now.
Let's lay it out. Let's look at the fundamentals, because if you just pull up their balance sheet without any context, it's a really tough read.
It's harsh. ACHR is currently a pre-revenue development stage enterprise.
Right, because their entire existence right now is just research, development, and building out these massive manufacturing facilities.
Exactly. So traditional metrics like current sales don't even apply here.
Yeah.
Their earnings per share over the trailing 12 months is sitting at negative $1.10.
Wow. And they have significantly negative free cash flow. Let me stop you there for a second, just to make sure we're all on the same page.
Go for it.
When we say negative free cash flow here, we aren't talking about a business failing to sell products. We're talking about a company spending hundreds of millions on heavy engineering.
Right. They're building aircraft, testing batteries, constructing assembly lines.
Years before they're legally allowed to sell a single ticket.
Precisely. They are building an entire aerospace infrastructure from scratch. But despite burning all that cash, they're still holding a massive market capitalization.
Yeah, of around $3.6 billion, which raises the obvious question, how on earth does the market justify valuing a company with literally zero current sales at nearly $4 billion?
Well, it comes down to how markets price innovation and future market share. If you look at their price-to-book ratio, it's hovering around 1.7.
Okay, and just as a quick refresher, the price-to-book ratio compares the market's valuation of the company to the physical value of its actual assets, right? Like cash, factories, patents.
Exactly. And in the high-growth tech and aerospace sector, a ratio of 1.7 actually suggests the market is valuing the company's underlying assets pretty reasonably.
So they aren't pricing ACHR based on yesterday's sales.
Right. They're pricing them based on the intellectual property they hold today and the massive slice of the transportation sector they could theoretically capture tomorrow.
And here's where the story takes a massive turn. Up until very recently, that tomorrow was all about passenger transport.
Getting you, a human being, from Manhattan to JFK in 7 minutes.
Which sounds incredible, but let's be real, building consumer trust takes so much time you have to convince the public it's safe. But then we got a major fundamental
A
catalyst.
total game changer. The partnership with Anduril.
Yes. For those who aren't familiar, Anduril is an absolute juggernaut in the defense technology space.
They really are.
So Archie partners with them and suddenly unveils this new platform called Halo. It's a commercial, unmanned, autonomous version of their aircraft.
And they also tease a hybrid platform called Thunder. Mechanically, this changes everything about Archer's competitive moat.
How so?
Well, before this announcement, they were stuck in a lane competing against other pure-play passenger eVTOL companies.
Right.
If you're only designing a flying taxi, your total addressable your TAM, is strictly limited to passenger transport. But by stripping out the seats and partnering with Anduril, Archer dramatically expands that TAM.
Straight into commercial logistics and defense applications.
Well,
Let's talk about the mechanics of this, because I think this is the brilliant, aha moment of the entire analysis.
it really is.
It's not the physical technology that changed, it's the customer. Think about the regulatory nightmare of getting the FAA to certify a new electric flying car for humans.
It's like trying to build and certify a brand new commercial airliner from scratch.
Exactly. You need perfect safety ratings, life support, emergency overrides, cup holders. Everything has to be flawless because human lives are at stake.
And the FAA takes years to approve that kind of novel architecture. It's an incredibly rigorous, slow-moving bottleneck.
But if you pivot to defense cargo, it is a completely different game. It's more like building a heavy-duty drone.
Right, you don't have to convince a crate of artillery shells that the flight is comfortable.
Exactly. You just have to prove to the Department of Defense that the payload gets from point A to point B autonomously. By bypassing the FAA's passenger bottlenecks, Archer just found a massive shortcut to actual revenue.
It's the path of least regulatory resistance. And the engineering synergy is what makes it so feasible.
Yeah, break that down for us.
Well, Archer spent years building the core hardware architecture, right? The proprietary electric propulsion, the battery systems, the aerodynamics.
Right.
But taking a human pilot out requires a completely different brain. That's where Anduril comes in. They provide the advanced autonomous software and the command and control systems.
So you take Archer's heavy lifting hardware, plug in Anduril's autonomous software, and suddenly you have a product the military desperately wants.
Stealthy electric autonomous supply lines.
And crucially, partnering with Anduril gives them a golden ticket into defense sector procurement channels, which, are notoriously difficult for Silicon Valley startups to navigate alone.
Oh, almost impossible.
Yeah.
Competitors who only make passenger vehicles suddenly look entirely one-dimensional compared to this.
Archer is no longer just a flying taxi company. They are a dual-use aerospace contractor.
And that phrase, dual use, is exactly what's driving the shift in market sentiment right now.
Let's follow that trail into the sentiment section. Because if the regulatory path just got shorter and the market just got bigger, who is noticing?
The institutional whales are definitely noticing.
Yeah, the most glaring example is Cathie Wood and ARK Invest.
ARK Invest actively added about $15 million worth of Archer shares to their portfolio. But the really telling part is how they funded that purchase.
Right, they didn't just have cash sitting around in a drawer. They actively liquidated a portion of their Robinhood position to fund this.
Which is wild. They rotated out of a stabilized, cash-generating financial tech platform to double down on a pre-revenue aerospace company.
Which gives you a fascinating look into their internal risk models, doesn't it?
Totally. Institutional funds like ARK don't make those rotations lightly. Moving from a safe harbor into a high beta moonshot indicates they see an asymmetrical upside that justifies the risk.
They aren't buying the flying taxi dream anymore. They're buying the defense pivot.
Exactly. They see the timeline to revenue accelerating.
But it's not just the institutions. Let's look at the insider footprint, because this is the specific data point that caught my eye.
The insider buying has been intense.
Yeah, over the last 90 days, company insiders have net purchased roughly 774,000 shares. That's 18 different buy transactions versus only 22 sells.
And they're scooping these shares up right as the stock is bleeding out near its 52-week low.
Which is crucial context, but I want to push back on that a bit. Let's look at this skeptically.
Okay, play devil's advocate.
As a listener, you've probably seen this happen. Is insider buying always a guaranteed bullish signal? Or is it sometimes just a desperate PR stunt by management to prop up a bleeding stock?
I mean, you always have to bring that skepticism to the table. A token PR stunt usually looks like the CEO buying a highly publicized, relatively small chunk of shares just to project false confidence.
Like, look, I believe in the company. Please ignore the fire in the warehouse.
Exactly. But what we're observing with ACHR is mechanically different. This isn't a PR stunt. This is cluster buying.
Explain why cluster buying matters.
When you look at the filings, it isn't just one or two executives. You have 18 different individuals across the upper echelons of the company executing buy orders.
Oh, wow.
Yeah, you cannot easily coordinate 18 different directors, VPs, and executives to risk their own personal after-tax wealth just to generate a positive news cycle.
Mathematically, that suggests a broad internal consensus.
Right. These people are looking at internal data, the test flights, engineering progress, partnership talks, and independently deciding the public market has priced the stock incorrectly.
So they know something the market hasn't fully digested yet.
They clearly have visibility that we don't. And if you connect the dots back to the Anduril partnership, there's a lot of logical chatter about potential upcoming DoD contracts.
Or maybe a pilot program announcement for the Halo platform?
Exactly. If you're an insider sitting in those DoD negotiations, buying shares at $4.30 probably seems like a generational opportunity.
Which brings us perfectly to the technicals. Because this heavy accumulation by insiders and smart money is leaving a very specific, volatile footprint on the chart.
It is a massive technical tug of war. If you zoom out, the long-term view is ugly.
Deeply damaged. The stock is trading around $4.77 right now. It's perilously close to its July low of $4.30.
And it's a long, painful way down from its 52-week high of over $14.
The returns are devastating if you've been holding. The 6-month return is down over 46%.
It's a classic capitulation chart. Retail investors who bought the flying taxi hype have been slowly bleeding out and giving up.
But contrast that long-term bleed with the near-term. We saw an explosive 20% surge driven directly by the announcement of that Anduril Thunder platform.
And it wasn't just a quiet little bump. The 10-day average volume exploded to over 38 million shares.
That volume metric is the Rosetta Stone for this chart, isn't it?
Absolutely. 38 million shares changing hands for a company this size that does not happen by accident. That indicates intense active interest from major institutional players stepping in.
Here is how I visualize what's happening mechanically on the chart. What we're seeing in that low $4 range looks like two tectonic plates grinding against each other.
That's a great way to put it.
On one side, you have exhausted sellers people down 50% who are finally capitulating. But instead of the price falling further, those shares are being aggressively swallowed up by strategic buyers.
ARK Invest, insiders, algorithms, they're building a wall at $4.30.
Right. Technical analysts call that an accumulation zone or base building.
The market is testing historical support levels. In the past, this 430 range held firm, and buyers are digging their heels in to make it a floor again.
But we have to factor in the volatility profile. ACHR has a beta of over 3.2.
Just as a quick reminder, beta measures how a stock moves compared to the broader market. The S&P 500 has a beta of exactly 1.
So if ACHR has a beta of over 3.2,
it means it's mathematically more than 3 times as volatile as the overall market. If the market sneezes, ACHR catches a cold. If the market rallies, ACHR goes into orbit.
Wild, unpredictable swings are just standard operating procedure here.
Because they're pre-revenue, their valuation isn't anchored to quarterly sales. It's anchored entirely to headlines and milestone funding.
Okay, so the chart is desperately trying to find a solid floor. But whether ACHR actually bounces back up depends entirely on them surviving long enough to execute this massive pivot.
Which means we need a reality check. Let's talk about the risks in the bear case.
Yeah, because the risks here aren't just minor speed bumps. They're existential.
We always have to bring the conversation back down to earth. The first major hurdle is regulatory execution.
Even though defense logistics is an easier path, it's still aerospace, right?
Right, it's highly regulated. Any delays in their testing timeline or software integration with Anduril severely pushes back commercialization.
And in the pre-revenue world, time isn't just money. Time is survival.
Which brings us to the massive looming threat hanging over every early-stage tech investor. Dilution.
Ah, yes. Cash burn is the silent killer.
Archer relies heavily on milestone payments from partners like Anduril and Stellantis. They hit an engineering goal, they get a check.
But if those milestones are delayed due to engineering hiccups,
The cash keeps burning to keep the lights on, but the replenishments don't arrive. At that point, Archer will be forced to raise capital just to survive.
let's explain exactly how that works mechanically, because dilution catches a lot of newer investors off guard. If a company runs out of cash, they can't just go to a bank and get a traditional loan easily.
No, they have to go to the open market and issue brand new shares of stock.
Right. It's like having a pizza cut into 8 slices. If the company suddenly creates 8 more slices out of thin air, the total size of the pizza didn't change, but your specific slice just got cut in half.
Exactly. Your ownership gets watered down. It dilutes the very shareholders who are bravely buying in now.
If they run out of runway, the reward for holding the stock is having your equity slashed.
It's the ultimate catch-22 of investing in early-stage deep tech.
So that sets up some massive upcoming catalysts you need to be watching. First up is their next quarterly earnings report.
Wall Street analysts aren't even looking at the revenue line. It is entirely about the runway.
Precisely. The earnings call will be heavily scrutinized for cash runway and capital expenditure guidance. You need to know exactly how fast they are burning through their reserves.
And when they expect the next injection of partner capital. You should also keep an eye out for any upcoming technical demonstrations or test flights for the new Halo platform.
Every successful autonomous flight is a major de-risking event that proves the Anduril integration works.
And finally, macro sector rotations. If we actually see the Federal Reserve cut interest rates, we often see a flood of money rotate back into R&D-dependent growth stocks.
Because lower interest rates make a company's future projected cash flows more valuable in today's dollars, right?
Exactly. When borrowing is cheap, investors are much more willing to take a risk on a company that might not turn a profit for another 3 years. Rate cuts are oxygen for pre-revenue tech.
Okay, so let me ask you the crucial question. How do you reconcile this? We have high institutional conviction, insider cluster buying, and a brilliant pivot.
Right.
But there is a very real mathematical threat that your shares could get diluted into oblivion if they stumble and run out of cash. How do those two realities coexist?
They exist together through the concept of an asymmetrical setup. As an investor, it's all about understanding what the broader market has already factored into the current price tag.
Okay, unpack that for us.
Because this stock has already been ruthlessly beaten down by 56% and is sitting down at $4.77, you can build a strong argument that much of the regulatory fear and the cash burn anxiety is already priced in to those lows.
Ah, I see. So the worst case scenario, or at least a highly dilutive scenario, is already reflected in the fact that the stock is cheap.
Exactly. The fear is already on the chart. So what you have remaining is a high-risk, high-reward scenario for a multi-year hold.
The downside is clearly defined by the chart's history, but if Archer successfully executes this dual-use defense pivot, the upside potential is massive compared to a $4 valuation.
That asymmetry is precisely what ARK Invest and the 18 insiders are betting on. They believe the potential reward vastly outweighs the known risks at this specific price point.
Let's pull all these threads together for the final verdict. We're looking at a pretty solid bullish score here for the long term, maybe a 7 out of 10, depending on how they manage that cash runway.
Definitely. Archer Aviation is presenting a deeply fascinating opportunity, precisely because it's in the middle of a profound identity transition.
It's no longer just a speculative consumer mobility play betting that you'll want to ride a flying taxi to work.
Right. Through this pivot and the Anduril partnership, it is actively transforming into a dual-use defense and logistics contractor.
It's a radical expansion of their total addressable market that completely changes the calculus of their potential enterprise value. They found the path of least regulatory resistance.
The smart money sees it, the company insiders see it, and the chart is currently a battleground to see if the rest of the market will finally believe it.
It is undeniably a multi-year story that's going to require some aggressive stomach lining to handle the near-term volatility. But as we wrap up, I want to leave you with a final provocative thought to mull over.
What's that?
If these autonomous defense and commercial logistics applications like hauling cargo for the military prove to be significantly more profitable and infinitely easier to get approved by regulators than passenger flights,
Yeah.
Will Archer eventually just abandon the futuristic dream of flying consumer taxis altogether?
Oh, wow.
Will we look back in 10 years and realize they became a pure, highly lucrative defense titan, and the flying car was just the prototype that got them there?
It's a fascinating question. I mean, why fight a decade-long battle for consumer trust and FAA approval when the military is standing there with an open checkbook for autonomous cargo? It makes perfect business sense.
Something to keep in mind the next time you see a headline about an EV tool company. Well, if you find our talks useful, please consider subscribe, like, and comment underneath.
And don't forget to check out that special 14-day trial link for Stock Oracle down in the description.
Yep, it's a great AI-aided stock research platform to help you build context, but always remember to verify the facts yourself. Thank you for joining us, and we'll see you next time on Smart Wealth with Joshua.